Hello, hello, everyone, all our listeners and viewers. I am going to be talking about the Ponzi scheme reporting again. Since I released my first video, I have had so many people reach out from other professionals to victims of the Ponzi scheme to um, actually many other firms to consult with us on how to properly handle the Ponzi scheme recovery reporting, and I wanted to shed some more light and provide a little bit more clarity from my first video. So what I want to go into right now is the documentation we're going to need to be able to substantiate the information, and also the difference between tax advantaged accounts versus regular accounts. And this will be an important part of the conversation because I want to make sure that I reduce and or eliminate any confusion with respect to what a tax advantaged account is and how the Ponzi scheme reporting and recovery for a theft loss will apply to that. All right. So bear with me here for a little bit. This is a very dense topic, so I want to make sure that I cover a lot of things here. And of course, if there's any questions, you can always reach out to me. And I'm really, really happy to help, as I feel terrible that a situation like this has occurred or can occur for any taxpayer or business or individual. And I'm glad that the IRS has a format to be able to follow, to be able to recover some of the investment that was made that was subject to the Ponzi scheme. And that's part of the IRS's safe harbor recovery. So that was addressed in a previous video. So here I'm going to expand on a few more things. Okay. So in order to assist an individual or a business in claiming a theft loss deduction under the IRS safe harbor provisions, you'll need to ensure that you have proper documentation and compliance with IRS's specific guidelines. I can't emphasize this enough. There's no shortcuts to this. We don't want you to cut corners, and the IRS certainly doesn't want you to cut corners either. The IRS generally does not allow deductions for losses within tax advantaged retirement accounts because these accounts already benefit from deferred taxation. So, in summary, and in short, I'll still go into a few more details here, but in summary, these would be your retirement accounts, your IRAs, your Roth IRAs, your 401ks, and your self-directed 401ks, IRAs, and Roth IRAs. According to IRS guidelines, you cannot claim a capital loss on investments within retirement accounts that receive favorable tax treatment. So I won't belabor this topic, but I just want to accentuate the difference here and in what we're going to discuss next. Okay. So first of all, we want to make sure you're a qualified investor, okay? And typically this includes any individual who invested cash or property in the fraudulent scheme with the expectation of profit, and they were unaware of the fraudulent nature of the arrangement. So that's a key definition here. So I want to make sure you walk away with that. Once again, I gave a little bit more detail in my first video. And next, we have to make sure that we're keeping proper documentation. So the documentation to gather here is pretty broad, but I'm going to give you some examples so that it could be a little bit clearer as to what's required. And hopefully this will help you gather information. What I also want to accentuate here, anything that you provide to your attorney or the receivership, you would also provide to us in order to substantiate exactly what you're trying to claim. And that's exactly what the IRS is looking for. Okay, so the first thing, and take notes here, we're going to go into investment records, we're going to go into fraud documentation, prior tax filings, legal fees, expected recovery, and business investment documentation. Okay. So I'm going to go through these one by one and take notes as you're doing this. You can always rewind the video to listen to it again. All right. So investment records. What we want to do here is we want to prove your financial involvement. So this is kind of clear, but just in case it's not, let's kind of dive into it. Bank statements showing the initial and subsequent investments made into the scheme. So essentially, what bank did you use? What was the date of the investment? What was the amount? Cancel checks or wire transfer confirmations used for deposits, brokerage or custodial account statements reflecting your investment, subscription agreements or investment contracts, and any correspondence, emails, or letters that you may have exchanged with the scheme operators confirming investment terms. You may want to pull all of those, but if you have at least some of those, that should suffice to be able to substantiate to the IRS. So as an example, a bank statement showing a $50,000 wire transfer to ABC Investment Fund on March 15th, 2024. Okay, that could be a potential example. Number two, fraud documentation. What does this mean? We want to show proof that the scheme was actually a fraud. Essentially, what we don't want to happen here is you losing money and you're upset that you lost your money and you think someone had defrauded you, which may or may not be true. What the IRS requests is actual fraud documentation proof that shows this was an actual Ponzi scheme. Okay. So follow me on this. So we need official fraud documentation. That could be from the SEC, the FBI, the DOJ, or receiver notices and correspondence. It could be indictments, judgments, or legal actions against a perpetrator. Receivership reports or liquidation notices showing fund status, or possibly, and once again, there's probably more things, but these are just the most common that we see, a class action lawsuit documentation, if applicable. So as an example, if the SEC press release confirming the Ponzi scheme investigation and listing investors as victims is released in the media or in the news or online, make sure you print a copy of it, save it to PDF, keep it in your Ponzi scheme recovery folder. Number three, prior tax filings showing scheme-related income. So essentially what we're trying to prove here is if the scheme was a multi-year scheme and you had received 1099s of earned income or earned dividends or distributions or capital gains, for example, and you reported that as income, then we want to be able to prove to the IRS that because it's a Ponzi scheme, those should not have been reported as income. And then now we'll be able to report them to be able to recover some of the losses. So some examples of this would be IRS forms, meaning 1099s issued by the Ponzi scheme perpetrators, 1099 interest, 1099 dividend, 1099-B for brokerage, 1099s consolidated, Schedule B, as in boy, for your interest and dividend details from prior year tax returns. And if you filed prior year tax returns, you would have had a Schedule B if you had multiple investments that you were recording so that the IRS has a detailed list. Schedule D, as in dog, capital gains and losses. So if you filed any capital gains in prior years, you would have used Schedule D to report it. Also, K1s from the investment. You would have received a K1 if it was from a partnership or an S corporation or some sort of LLC, and you would have received that K1. So for example, in 2024, you receive an IRS Form 1099 interest from ABC Investment Fund reporting $5,000 in interest income. That could be supporting documentation for you. Number four. Okay. Legal fees incurred due to the fraud. if applicable. This will not apply to everyone. Retainer agreements and invoices from attorneys hired for loss recovery, proof of payments, canceled checks, credit card statements, wire transfers, etc., and engagement letters with forensic accountants or consultants assisting with recovery. I'm going to point something out here that not all legal fees are recoverable. So we have to be very detailed, and it will depend how and when they were incurred so that we can advise you on if they are actually deductible for you or not. Number 5, expected recovery documentation, if any. This is very, very important because the expected recovery of anything that you anticipate to receive from the receivership or from anywhere or from a lawsuit, that is used to create the formula of what you're able to deduct for the current year losses for the safe harbor rule from the IRS. So this is very, very important. So this could mean any communications from receivership firms estimating potential recoveries, insurance claims or reimbursements filed for investment losses, litigation claims submitted in pursuit of financial recovery. So, an example of this, which is what we've been seeing a lot of, is letters from receiverships. So, let's say you get a letter from the court-appointed receiver estimating a 20% recovery of invested funds within 3 years. That could be used as an example. Okay. Number 6, business investment documentation, if applicable. Depending on what type of business you have, will determine how the Ponzi scheme reporting is being reported. So if investments were made through an LLC, an S corporation, or partnership, or LLC electing to be an S corp or partnership, you'll provide similar things as stated above, except please note that these are going to be in your business name. They're not going to be in your individual name. They're not going to be in your social security number. They're going to be in your business name and business EIN number. So as an example, business bank statements showing investments into the scheme, date and the amount. Corporate tax filing reflecting investment activity. Show prior year tax returns where that investment was actually reported on your balance sheet of your tax return. Meeting minutes or business resolutions related to the investment. This is super, super important, right? So if you had these types of investments, how do you prove to the IRS that your business was able to and was approved by the shareholders or by business management to be able to make such a decision? Your meeting minutes are going to be able to do that for you. Any business tax filings indicating revenue from the fraudulent investment, business financial statements impacted by the fraud. Okay. And an example would be a company general ledger showing an entry or a journal entry or a bank deposit in your accounting system for $30,000 investment made from the business account. Okay. So it's pretty self-explanatory, but in times like this, when you may be scrambling for information, these are the exact steps of what needs to be done. Number 7, which I didn't mention before, but the final thing is correspondence with a fraudulent investment firm. This kind of adds light and color to everything happening. So emails, letters, or messages from the scheme representatives, newsletters, investment reports, quarterly statements from the fraudulent entity, and any redemption requests that were denied or unfulfilled. So these would be great examples of, what you can use to be able to substantiate your documentation. All right. Documentation is important. Document, 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 document. I cannot emphasize this enough. And then once you have all that and you submit it to your tax preparer, your tax strategist, your CPA, your enrolled agent, they'll be able to use that information and pull all the information that they need so that they can fill out all the required forms from the IRS and follow the IRS's rules to properly report it on your behalf. Okay. So that's super, super, super important there. So I also want to mention the tax advantaged accounts, and this has also been, a point of contention because there's quite a few individuals that we've spoken to where they didn't invest individually and they didn't invest through their businesses. They ended up investing through their self-directed IRAs or self-directed Roth IRAs, self-directed 401ks, and in there your recovery is absolutely limited. So that's been a super frustrating issue because people thought that they were making these protected and safe investments where in fact they weren't safe and now they can't recover what they're trying to recover. Um, so in these situations, I would still keep the documentation. Just know that your recovery process will not be the same, and your recovery process will be minimal to none, leaning on the none side. Um, so just keep an eye on that. Um, the interesting things that we want to make sure that we're looking out for is the fact that in the future, and I will do another video on this very, very specifically. In the future, there are some potential tax planning strategies for Ponzi scheme losses. I don't want to use our time here today to be able to discuss those, but I want to make sure that there are some opportunities, and these are typically when you have significant losses that that maybe are being carried over into future years. So just know that that's something that's super, super important to look at. What I also want to mention here is the nuances that are often overlooked. So there's nuances obviously in everything we do with the IRS, but here most specifically there's a partial recovery and clawback nuance that's super, super important to make sure you're keeping an eye on. So, if a victim later recovers funds, right, through lawsuits, receivership distributions, or insurance claims, the IRS requires them to adjust the theft loss deduction accordingly. So this can mean a few different things. So if you receive additional funds after claiming the deduction, you'll need to report that as additional income. Okay. If you receive less funds than you initially reported in your safe harbor ruling, then you'd have to amend the prior year tax return to reflect that deduction to be able to recapture some more losses that you initially didn't anticipate would happen. So I just want you to be aware of this because there is a possibility that you may have to update tax returns or you may have to report income down the road. So one of the things that I encourage you to do is to keep an eye on receiving any monies from the receivership or any lawsuits so that you can keep track of it significantly. And, we have a tracker that if you're interested, just reach out to us and we're happy to forward that to you to hopefully make that a little bit easier for you. Um, as a reminder, the safe harbor election is irrevocable. And that means you cannot change it. Once you elect it, that's it. You've elected it. So you can't change it and you can't change your approach and what you're trying to do here, right? So you can't change it, a year or two down the road just because you're trying to find a better way to claim the losses. It's irrevocable. If a client chooses not to select the safe harbor, you may independently prove your loss under general theft loss rules, and the IRS allows that. However, be aware that it's a higher audit risk and the safe harbor actually almost entirely eliminates the audit risk. So that's super, super important. The timing of the deduction is important, and the timing of the deduction is entirely around the year of discovery. The year of discovery is typically the year in which the fraud is publicly exposed. often via indictment, receivership, or SEC action. So make sure you have that factored into here. And calculating the deductible amount, right? 95% deduction if the taxpayer is not seeking third-party recovery, meaning no lawsuits or no pending claims. And if you are expecting future recovery, it's a 75% deduction in the year of discovery when you reported on your tax return. So just be aware of these things. And I don't expect all our taxpayers or clients to understand that, but be dangerous in the questions that you're asking so that you know what's happening with your tax return. Okay. And there's special treatment for pass-through entities like S corporations and partnerships, or LLCs that are S corporations or partnerships. And essentially, the losses are claimed there and they will pass to the appropriate shareholders via K1s so that it's still reported on your Schedule A of your personal tax returns. Another thing to consider is if you're amending prior year tax returns, you only have a 3-year ability to look back and amend. So make sure that you keep an eye on that in case you do have to amend something in the future. Okay? Your states are going to potentially have different rules about reporting this, so make sure you're aware of that and that doesn't throw you for a loop. And also, some Ponzi scheme victims may actually be generating net operating losses. So, net operating losses are an interesting factor because they can be used in some strategic tax planning down the road. All right, we went through a lot of things today. We went and covered the overall Ponzi scheme platform and how you can report items to the IRS, the documentation recovered, what tax advantaged accounts are, and some of the items that are typically overlooked. So for you to keep an eye on. So I truly, truly hope this helped. I know this is not a good situation for anyone to be in. And if you found this video helpful or valuable, please like and comment below, share it with others. We want to make sure that others are aware of what potential recoveries they have for themselves. All right. Have a great one. Bye.